In this video, we're going to go one step further in our analysis, and we're going to talk about the cost, volume, profit, income statement, and we're going to discuss a topic called contribution margin. It's a very important calculation that's very useful in a lot of instances in making decisions. It can create a shortcut for us, if you will. So again, the cost, volume, profit analysis, we're looking at the effect of changes in costs when the volume of the company changes and how that impacts profits. So it's very important for profit planning. It's a critical factor, right? So some of the things that we'll talk about over the next several videos: how do you set selling prices? What price should you have? What is the product mix of the company so that we can maximize operational efficiency and profits? And how can we maximize the use of our production facilities? So these are some of the decision questions that we'll be looking at and addressing over the next several videos. So what is it that we need to know? We need to know our activity level, right? We need that activity index. We need to know the unit selling prices. We need to know the variable cost per unit. We need to know the total fixed cost. Again, remembering the difference here between variable and fixed. For our mixed costs, we need to be able to segment those. And of course, we need to understand the sales mix of our products. And here you can see an apparel store, right? They have jackets, they have shoes, they have shirts, they have purses. That's what we refer to as the sales mix, right? What is the optimal mix given our variables here for the company? That's a very important question as we understand buying inventory, for instance. So what are the basic assumptions? First of all, that the behavior of costs and revenues is linear throughout the relevant range, right? Now, we saw some in previous videos when we looked at how costs changed relative to activity level. There is a curve, a linear piece. But when we looked at our relevant range, we found that that range, the actual lines, right, the relationship was very linear, right? It wasn't curvilinear. Of course, we can accurately classify costs. The change in activity is the only thing that affects costs. All the units we produce, we're going to sell. And if we have one type of product sold, we have more than one type of product, whatever the mix is, for right now, we're going to assume we're going to keep that the same, right? So we're not going to change anything today about what we sell and when we sell it. So what is this income statement? It's an internal use document. So you won't see this document in an annual report. It looks at costs and expenses as either fixed or variable. It calculates or shows us something called the contribution margin. This is the amount of revenue left after we deduct variable costs. We'll have some formulas here coming up. This is the amount that contributes to the fixed costs. So if you sell something for $10 and the variable cost per unit is $6, every time you sell a unit, you make $4 in what's referred to as contribution margin. That first unit you sell, $4 of profit, goes to cover the fixed costs. Now, after all the fixed costs are covered, then this contribution margin now converts, if you will, to the profit per unit above that level. Right? So again, in the end, we should have the same kind of net income as in the traditional statement. We're looking at our expenses and costs a little bit differently. So here we have an electronics company. The relevant data, $500 is the selling price of a cell phone. unit variable costs are $300. Total monthly fixed cost is $200,000. And the unit sold is $1,600. Again, they make reference down here that they've looked in and considered all the costs are included here. So what does the income statement look like? Well, we sold 1,600 units at $500. 800,000 is sales. Variable cost, 1,600 times 300, $480,000. So the contribution margin total is $320,000. So now this company has $320,000 to cover the fixed cost. In this case, fixed costs are $200,000. So the profit or the net income is $120,000. So how can we discuss this a little bit further or break it down into a little deeper detail? We can look at the unit contribution margin. So this is, again, the amount that's available to cover fixed cost and ultimately contributes to income. If you take the unit selling price, subtract out the unit variable cost, in this case 500 minus 300, the unit contribution margin is $200. So how does this work, right? So here's the units, $200. If we sold 1,000 units, 500,000 sales, 300,000 is variable cost, a contribution margin 200,000, fixed cost $200,000. The net income is zero. So what we'll find out in a later video is this 1,000 unit mark is what we refer to as the break-even point. That's the point where the contribution margin exactly equals fixed costs, so we end up with zero net income. Now, if we sold one more unit, if we sold 1,001 units, what would the profit be? Well, we can go through all the steps here, right? You can do the calculations, it's $200. But an easier way to do this is say, look, if I know the break-even point is 1,000 and I sell 1,001, what profit do I make? Well, everything over 1,000 units has a profit of $200 to the bottom line. So 1 times 200 is this. What if you sold 1,100? Well, it's 100 times 200. That would be what? $10,000 would be the profit if you sold 100 over the break-even point. So again, it's just some shortcuts allow us to develop an understanding of the profit potential of the company. There's another ratio that shows the percentage of sales dollars that goes to fixed costs and profits. It's called the contribution margin ratio. You take the contribution margin and you divide it by the unit selling price. So of every dollar that's sold, there is a 40% contribution of that dollar to fixed costs. So again, here we have, if it's 1,001 units, 5,500. The cost, we have 200,200. We know that what? That the variable cost is 60% of sales. So that means the contribution margin is 40%. So how can we look at this, right? So the company says, look, if I'm selling 1,000 units, what's going to happen if I sell 200 more units? Well, I can go through all the contribution margin aspect, but we know what? At 1,000 units, we break even, right? So at 100 units, we break even. If you increase by 200, and it is $200 per unit profit above break even, you know that net income eventually is $40,000. So again, the process, we can go through the statements, and that's nice. But to see how the increase in sales works, again, if we know break even, this calculation, this concept is very simple. If you don't know break even, then you do have to go through this process to make sure you understand the entire net income statement here. Again, rather short kind of a video, just talking about the income statements that we can look at when we're making decisions on activity levels and how that affects profits of the company. Look forward to seeing you in the next video.